Welcome back. In our previous lecture, we have covered the cost of preferred stock. In this lecture, we are covering the cost of common stock. To find out the cost of common stock, we need some background of common stock valuation model, and one of the most popular common stock valuation model is constant growth model. As per this model, it is expected that firms' dividend payments will grow at a constant rate, but the growth rate of the dividend payment will be less than the required rate of return. So as per this model, P0 indicates price of the or value of the stock, T0 indicates current dividend payment or most latest dividend payment, G indicates the growth rate of the dividend payments. Constant growth model is also known as Gordon growth model or simply the Gordon model. That is the shorter version of this model. P0 indicates value of this stock or restricted value. D1 is the next year dividend payment. D1 is equal to simply D0 into 1 plus T. R indicates required rate of return and G indicates growth rate of the dividend payments. Here is the historical dividend payments of Lunar Company. So as per this table, the latest dividend payment by the company is $1.40. So from this table, we can find out the growth rate of dividend payments of Lunar Company using Excel or financial calculator. So the growth rate of Lunar Company dividend is 7% and the required rate of return is 15%. So using a growth rate of 7%, growth rate of dividend payment 7%, we can find out next year dividend payments. So as per this table, the most recent dividend payment of Lunar Company is 1.40. So next year dividend payments will be 1.40 into the growth rate of the dividend payment, which is 7%. So 1.40 into 1 plus 0.07, and the next year dividend payment will be 1.50. Required rate of return of this stock is 15% or simply 0.15, and the growth rate, we already know the growth rate is 7% or 0.07. So based on this information, value of this stock should be 18.75 per share, or restricted value of this share is 18.75 per share. Now let's look at capital asset pricing model. So the total risk of any security is a combination of non-diversifiable risks and diversifiable risks. Diversifiable risks are the portion of an asset risk that can be eliminated through diversification. This risk, that means the diversifiable risk, is also known as unsystematic risk. So diversifiable risk can be eliminated through diversification. So investor can eliminate the diversifiable risk. Non-diversifiable risks cannot be eliminated, like natural disasters or stock market crash. These sort of risks are known as non-diversifiable risks, and keep in mind that non-diversifiable risks are also different for different stocks or for different businesses. Non-diversifiable risks cannot be eliminated through diversification, so only relevant risks for the investors should be non-diversifiable risks, or in other words, investors or financial analysts should consider non-diversifiable risks only, because diversifiable risks can be eliminated. So it is saying that final line is only relevant risk is non-diversifiable risk for the investors or financial analysts. Now, using beta coefficient, which is a measurement of non-diversifiable risks, we can also find out the required rate of return of a stock and assets. At the beta coefficient simply shows the relationship between an index of degree of payments of when stocks or assets return in response to a change in market return, or in a simple word, beta coefficient of a stock or asset shows the relationship between the stock or assets return and market return. And assets historical return are used to find out beta coefficient of a stock or asset, and the beta coefficient for entire market is equal to 1, and the market return is the return on market portfolio of all credit assets. So this is the formula of capital asset pricing model. As per this formula, R indicates the required rate of return on asset J. RF indicates risk-free return, which is commonly the return of treasury bill of any country. B indicates beta coefficient or non-diversifiable risks of an asset. RM indicates market return. So we can also find out the cost of capital using this model. There is an example of capital asset pricing model, and using this capital asset pricing model, we can find out the required rate of return of Benjamin Corporation. So Benjamin Corporation has a beta of 1.5, risk-free rate of return is 7%, and market return on portfolio of asset is 11%. So using CAPM, the required rate of return of Benjamin Corporation is equal to 7%, which is the risk-free rate, plus 1.5, which is the beta, into market return, which is 11%, minus the risk-free rate, which is 7%. So required rate of return of Benjamin Corporation is 13%. So using the CAPM, we can also find out cost of capital. Using the CAPM, we can also find out the cost of common stock. The firm can raise equity in two ways. The number one option could be retained earnings, and second option could be new issues of common stock. And firms' common stock or firms' cost of equity can be found using dividend valuation model and capital asset pricing model. So there are two options to find out the cost of common equity. Number one option could be dividend valuation model, and the second option could be capital asset pricing model. So if we use the dividend discount model, we can use the constant growth valuation model, which is simply RS, which is a converted version of constant growth valuation model, which is simply RS, indicates cost of common stock equal to D1 divided by P0. D1 indicates next year dividend payment divided by P0. P0 indicates current stock price plus growth rate. If we use capital asset pricing model, the equation will be like RF, which is the risk-free rate, plus beta, which indicates which is a measurement of non-diversifiable risks, into RM, which means the market return, minus RM, which is the risk-free rate. Risk-free rate of return. We know that risk-free rate of return is normally the return on treasury bill. There are some differences between capital asset pricing model and the dividend discount model. If the capital in the capital asset pricing model, firm's risk is measured by the beta, or firm's risk is reflected in beta. On the other hand, If we use dividend valuation model or simply the Gordon growth model, this model does not directly consider risks. However, if we use dividend valuation models, the market price would reflect the expected risk return preference of the investors. So, market price or simply P0 reflects risk return preference of the investors. So, indirectly, dividend valuation model also considers risks, which is resembled by the risk return preference of the investors in the market. It is assumed that both models, that means the dividend discount model and dividend discount model, valuation model, and capital model are theoretically equivalent to find out the cost of common stock. But in reality, it is often found that two models, that means the dividend discount valuation model and capital asset pricing model, provide different results in case of estimating the cost of new equity. So here is an example of cost of retained earning. So you can find out the cost of retained earning using constant dividend growth model. As per this model, cost of retained earning, that means the RS is equal to D1 divided by P0 plus G. D1 indicates next year dividend payment, P0 indicates current stock price, G is the growth rate of the dividend payments, and we know that RS indicates cost of retained earnings. So here is the example. A firm just paid a dividend of $2.50 and its growth rate of the dividend payment is 10%. So as per this information, next year dividend payment should be 2.50, which is the recent dividend payment, into 1 plus 0.10 equal to $2.75. So D1 is equal to $2.70. So, and the current selling price of this stock is $50. So based on this information, cost of retained earning is equal to next year dividend payment, which is $2.75 divided by $50, which is the current selling price of this stock plus growth rate of the dividend payment, which is 10% or simply 0.10. So as per this information, cost of retained earning of this stock or for this firm is 15.5%. Now we can also find out the cost of retained earning using capital asset pricing model. So for example, 3-month treasury bill rate is currently 5%, market risk premium is 9%, and firm's beta is 1.10. So based on capital asset pricing model, firm's cost of retained earning is 15.8%. So this 5% is the risk rate, 1.2 is the beta of this stock, and 9% is market risk premium. So the result is 15.8%. In our previous example, we have seen that the cost of retained earning as per dividend discount model or Gordon growth model is 15.5%. But as per the capital asset pricing model, the cost of retained earning is 15.8%, which is slightly higher than the cost of retained earning which is found by Gordon growth model. So it is safer to use 15.8% because this is slightly higher, and it will eliminate all the errors in the model. So in this lecture we'll consider the cost of retained earning throughout this lecture, we'll consider cost of retained earning for this stock is 15.8%. Now let's look at cost of new equity. To find out cost of new equity, we need to also consider flotation cost. That means the cost of issuing and cost of issuing and other costs to issue a new stock. So when a firm raise new equity or when a firm sell new equity or share, firms need to consider some costs. Those costs are known as flotation costs. Say for example, this firm's flotation cost per share is $40. So we know that current stock price of this share is $50 and the flotation cost is $40. So as per this information, net proceeds of this stock is $50 minus the flotation cost, or simply $46. So from our previous example, we have calculated the next year dividend payment is $2.75. So in this example as well, the next year expected dividend payment is $2.75. Then and this is the net proceeds, which is the current selling price of this stock minus flotation cost 50 minus 40 plus growth rate of this dividend payment of this stock is 10% or simply 0.10. So the cost of new equity as per this stock is 16%. So you know that cost of retained earning is we have considered the cost of retained earning as 15.8% as per the capital asset pricing model, and based on the constant dividend growth model, cost of retained earning is 15.5%, but cost of new equity is 16%, which is slightly higher than cost of retained earning. This is just because of the flotation cost, as there is always a cost to issue new shares. The cost of new equity will be always higher than cost of retained earnings. That's all about this lecture. In our next lecture, we'll cover the weighted average cost of capital.